All right, so let's begin with our segment, Meet Your Fund Manager. And before that, let's talk about the Indian markets. Indian markets entered bear territory today with Nifty down over 2%, closing below the 24,100 levels. It registered the biggest single session decline in over 2 months. All broader and sectoral indices declined, with realty declining the most. And additionally, the Indian equities plunged dramatically start of the week, mirroring a global sell-off triggered by a sharp sell-off in the Japanese market, resurgence of recession fears in the US, and mounting tensions in the Middle East. So let's dive deep in this and let's talk about the probable trajectory of the market going ahead. And also, if you are a small cap investor and if you are putting money in PGIM India Smallcap Fund, what should be your strategy today? I have with me Vivek Sharma, Senior Fund Manager, Equities, PGIM India Mutual Fund. And Vivek, good evening and welcome to the show. And yes, definitely. I have a lot of questions for your fund, and investors also want to know about your strategies going ahead on that fund. But then before that, let's talk about the sell-off that we saw today. It was expected looking at the Friday closing of the US market. But then going ahead, what will be on radar for you tomorrow when the market opens?
Okay, thanks, Kavita. Thanks for having me on your show. Good evening to you and all our viewers. So today's sell-off was, in our opinion, more led by macro events. Especially, there have been news about yen carry trade unwinding. So India was not the only market that saw a sell-off. Globally also we saw markets falling. So India was more of the same in that regard. But I mean, since this is more of a global driven event, I would not be too much worried about today or tomorrow, or especially the long term. Yes, when we talk about in short terms, volatility, especially in small caps, tend to be a bit higher. But when you invest in equities, you invest for the long term, and for the long term, I would not be too much worried about external events specifically, hindering my long term returns.
Sure. Being a market participant, would you be considered about the valuations now? Where all are you keeping a close look in terms of valuation getting realistic, or there still being froth on it, especially the mid cap and small cap space?
So yes, you rightly pointed out valuations in certain pockets of the market seem to be building a lot more. Typically, the driver of a stock price is typically earnings growth, some PE rating, and in some cases, both of them. So wherein earnings growth is not there, but the PE has seen a significant de-rating, there we see a lot of euphoria and exuberance building on. So that is one pocket of the market, in sectors like, some of the capital goods, some of the railways, some in PSUs. But I would like to caveat that when I make these statements, not all PSUs or capital goods or defense names are, in that territory. However, some of them, because of unrealistic or too large an earnings increase have been built in, which may or may not fructify, and therein we would be a little bit skeptical about those being fructifying in the near future.
So, a lot of different type of investors with different appetite and time horizon watch our show. There are definitely long-term investors who invest in direct stocks and also have exposure via mutual funds. But there are also short-term and near-term investors and traders. Now, talking about near-term outlook and talking specifically about investors who churn their portfolio, also have a risk appetite to do that, obviously. What are the sectors that they should be looking at after this kind of a heavy correction? A lot of experts are of the view that, just sit back right now, do not put any money. Let's see 2-3 more sessions of the market, and then maybe you can decide what should be your strategy. But having said all of that, what would be the sectors on radar, or they should be keeping their money ready, and just when there is a comfortable zone coming in those particular sectors or counters, they should be putting in money? What would you say?
So, Kavita, any sector or any company wherein you're not paying too much vis-a-vis its valuations or vis-a-vis its growth that the company or sector is offering would be a good candidate. But given the fact that, let's say, the small caps and mid caps over the last 4 or 5 quarters have given very stupendous returns, I would not hesitate in saying that we may have borrowed some returns from the future for the short term. However, there are still some sectors which have not participated as much in the rally wherein earnings growth are still decent. So some of the sectors that come to mind is, let's say, the consumer sector, wherein in general, the corporate governance of the companies are very good. They have immaculate balance sheets and they are growing at a decent clip, given the fact that India is a consuming economy and growing economy. Per capita income, closer to $2,500 is, increasing at a steady clip. So that is one structural sector we see that should offer good growth prospects, irrespective of whatever time period of your investing is. At the same point of time, this sector has not participated as much as in the rally as some of the other sectors have been. Second sector that comes to my mind is the healthcare sector. Again, this is one sector that is structural in nature. If you look at healthcare companies in the West and what has happened over the last 2-3 decades, that this sector has been continuously broadly growing, and there is a fair amount of inflation, let's say particularly in the hospital space. I see no difference that in India too there would be healthcare inflation, and hospitals, segments like hospitals are a good way to capture it. Third segment that comes to mind is probably an IT sector, which was a laggard in the probably whole of last financial year. It has seen some green shoots, given the fact that there could be rate cuts in the western part of the world, followed in India and in India as well. So most of the Indian IT companies are westward looking. They have the export oriented companies. 70-80% of the revenue comes from western part of the world. So a rate cut should help in general the economies and as well as the corporates, the BFSI sector in the western parts of the world, which are major clients of IT companies. So these are three broad segments we would be positive on from a short to medium term as well. And these are some of the sectors where we are overweight also in our small cap and mid cap portfolios.
All right, let's focus on your fund and PGIM India Small Cap Fund. How are you trying to mitigate the risk for the investors in this particular category?
So Kavita, very good question. At this point of time, the one way of mitigating risk is to avoid overpaying for growth. As you say, as I told you, that a fair amount of earnings growth is being built in some of the valuations of some of the high flying sectors. The problem with these companies or sectors is when earnings growth are even a tad below or they do not meet their earning estimates, there is a double whammy of earnings cut as well as P derating. That leads to a major correction in some of these stocks. As long as we are not overpaying for growth and whatever we are investing is structural in nature and we are fairly convinced about the long-term growth prospects of the company, I think if we are doing that, we are kind of mitigating the risk as well as participating in the long-term growth story of these companies.
Sure. Can you also talk about your sector exposure, at least top 5 to 7?
So we are positive on, as I said, consumer sectors, both discretionary and staples, we are positive on. We are positive on healthcare sector. There are various segments in healthcare, such as US generics, hospitals, Indian pharma. We are more positive on hospitals and US generics. IT is one sector where we have over the last quarter or so, we have been reducing our underweight and we have turned mildly positive. Financials, a pocket of it wherein we are positive. We are slightly negative on where valuations are not in our favor, or wherein such as PSU sector in the financial space, where we are kind of avoiding at this point of time. On the negative side, we are not very positive on sectors which have a global commodity kind of or cyclical kind of exposure. So materials would be one sector. And we would be negative on energy sector, given again global linkages, as well as the fact that a lot of the fortune of these companies depend on government regulations, which is very difficult to forecast. Governments do have their own fiscal compulsions, so they may take decisions in the short term which may not sit well for the minority shareholder of such companies. So we are avoiding those sectors at this point of time. But at the same point of time, there are some companies and sectors within these sectors also which meet the criteria of reasonable growth, run by competitive management. So we are investing in that, but we have less than, let's say, the benchmark exposure in some of these sectors.
All right, talking about consumer durable being your top sector, what kind of trajectory are you banking on, and what could be the theory behind this being the highest exposed sector in your fund?
So, Kavita, as I said, India is, we are expected to grow our GDP in the range of 7 to 8% broadly on a real basis. On a nominal basis, you make it 12 to 13%, you add inflation. So when the broader economy is growing at 12 to 13% on a nominal basis, typically what it results in rising per capita income. Now India is at a very sweet inflection point wherein our per capita income has probably crossed a threshold wherein after a certain let's say income level, your consumption of your basic necessities do not rise at the same pace, but your some of the goods and services which you could not have afforded earlier becomes affordable, and hence consumption of discretionary items rises at a better pace. So you witness a J curve in consumption after a certain per capita income threshold. India is probably at that threshold. We have seen enough examples in other Asian economies or the Western economies when they were at a similar per capita income adjusted for PPP. So India's that per capita income rising leading to better discretionary consumption. So we are positive on segments of the economy wherein which is discretionary in nature, such as hotels or restaurants or eating out, durables, wherein affordability becomes better and hence consumption rises at a faster pace. And if we also look at some of the metrics such as per capita consumption of some of these segments or their absolute size in dollar amounts, they are very low when compared to even the developing nations in Asia. So we see a long growth prospect for these companies given the fact that it has become affordable, as well as now the fact that these companies are also available to us to invest. 10 years ago, 15 years ago, there were not many restaurants, very few hotels, very few luggage companies which were listed. Now we have more options to invest, and which is also a representation of the fact that these companies are also growing at a faster clip.
All right. Looking at your year return, it's almost 34.5%. Should investors be expecting the same kind of return trajectory?
Kavita, it's very difficult to forecast forward returns. However, given the fact that when you invest in small caps or to an extent mid caps, these are generally a bit more riskier companies than large caps, which have established market shares, lower cost of funding or lower cost of capital. These companies are typically a little bit more riskier in nature, and hence, since you are assuming more risk, you should earn better reward than some of the, let's say, the large cap segment. Now, endeavor is to keep on investing in growing companies wherein they are run by competent managements, do not take too much of balance sheet risk, are good capital allocators. So, if as I said, if India continues to grow at 13, 15 or 13 or 14% on a nominal basis, I'm sure some of the mid caps and small caps will grow at a much better pace, given the fact they are smaller in size. Some of them are challenging their larger competitors. So growth rate should, in general, the earnings growth rate of these companies should be better than what the country is growing at. And hence stock prices should also be a reflection of the earnings growth. If you get a P multiple rating, that is a bonus on top. But earnings growth should be the key driver, and these companies should be growing at the levels which I mentioned.
Sure. Thank you so much, Vivek, for being on the show and helping our viewers understand a lot about their small cap investments in your funds. Thank you so much.
Thank you for having me on your show. Good evening.
Let's take a quick break, and post that, let's talk about your financial portfolio. I'll be joined by Hemant Sustagi, who will be taking your questions live and doing your live financial planning after this break.